One of the most widely discussed developments in the silver market right now is China's reported import of more than 790 tons of silver during the first 2 months of 2026, including nearly 470 tons in February alone, the highest February intake ever recorded. On the surface, this appears to be an unmistakably bullish signal for the global silver market. However, interpreting this data correctly requires a deeper structural understanding of how commodity flows actually behave inside industrial economies like China's. The prevailing narrative suggests that China is aggressively accumulating silver as part of a strategic reserve strategy while simultaneously restricting exports to only 44 authorized companies beginning January 1, 2026. That interpretation implies tightening global supply conditions and strengthening long-term price support. But there is another interpretation that deserves equal attention. China is first and foremost the world's largest industrial consumer of silver. Solar manufacturing, electronics production, electric vehicles, and high-frequency communications infrastructure together require enormous quantities of conductive metals. When imports rise sharply, the immediate assumption should not automatically be strategic hoarding. It should instead be evaluated through the lens of industrial throughput normalization following supply disruptions and manufacturing acceleration cycles. China's PMI data recently exceeded expectations, signaling expansion in the manufacturing sector. That alone provides a sufficient explanation for elevated silver imports without requiring the assumption of geopolitical stockpiling behavior. In fact, when industrial demand accelerates after a weak cycle, raw material imports often surge temporarily as manufacturers rebuild inventory buffers that were previously depleted during slower economic periods. In other words, strong imports do not necessarily confirm long-term scarcity. They may simply reflect short-term replenishment. This distinction matters because commodity markets frequently misprice temporary logistical adjustments as structural supply shocks. Investors often interpret import spikes as evidence of tightening global availability when they are actually evidence of inventory rotation within manufacturing supply chains. Even the export restriction policy involving 44 authorized companies deserves closer examination. At first glance, limiting export channels appears to support the idea that China is locking silver inside its domestic borders. But selective export authorization is not unusual for industrial policy management. It allows governments to maintain quality control, stabilize internal supply distribution, and prioritize strategic sectors without necessarily signaling an intention to accumulate permanent national reserves. This type of administrative filtering has historically been applied across multiple resource categories in China without always translating into immediate global price dislocations. More importantly, the assumption that China's behavior alone can determine the direction of global silver pricing overlooks the reality that the international silver market remains heavily influenced by futures liquidity dynamics on major exchanges such as COMEX and London. Physical imports into China may tighten regional availability, but they do not automatically constrain the global derivatives-driven pricing structure that continues to dominate short-term market behavior. That difference between physical movement and financial pricing is critical. While it is true that global exchange inventories have declined in recent years and that the silver market is projected to enter its sixth consecutive annual supply deficit, the scale of that deficit, approximately 67 million ounces, must be evaluated relative to total annual supply near 1.05 billion ounces. A deficit of that size represents structural tightness, but not immediate scarcity capable of forcing rapid repricing across leveraged futures markets. Markets rarely respond to deficits simply because they exist. They respond when deficits become unmanageable, and at present, there is still sufficient above-ground inventory and recycling flexibility to absorb short-term supply imbalances without triggering disorderly price expansion. This is where the mainstream bullish interpretation begins to lose analytical precision. It assumes that import strength equals accumulation, that export control equals restriction, and that deficits automatically equal scarcity. But commodity markets rarely operate that simply. Supply chains adapt, substitution occurs, recycling expands, and speculative positioning in futures markets often overrides physical fundamentals for longer than investors expect. Understanding this difference between narrative strength and structural evidence is essential before drawing conclusions about silver's long-term trajectory. Because what appears at first glance to be a tightening market may instead be a market transitioning through a temporary industrial demand cycle rather than entering a permanent physical shortage regime. And that distinction changes everything about how investors should interpret what happens next. Another major pillar supporting the bullish silver narrative right now is the argument that the global market is entering its sixth consecutive annual supply deficit, with demand projected to exceed supply by roughly 67 million ounces in 2026. On the surface, this sounds like a textbook setup for sustained price appreciation. However, the relationship between supply deficits and price direction in commodity markets is far more complex than it appears. A supply deficit alone does not guarantee rising prices. What matters is whether the deficit becomes disruptive enough to force repricing across the financial system that determines market liquidity. And in silver's case, the scale of the projected imbalance still remains relatively modest when compared to total annual supply, which is expected to exceed 1 billion ounces. That means the deficit represents structural tightness, not immediate scarcity. Commodity markets frequently operate in deficit conditions for extended periods without triggering price breakouts. Oil markets have done this. Copper markets have done this. Even agricultural markets regularly experience supply gaps that fail to translate into sustained rallies because inventory buffers and recycling flows compensate for shortfalls. Silver behaves the same way. Mine production is expected to increase slightly this year, and while that increase is only around 1%, recycling activity historically rises when prices remain elevated. Higher prices incentivize recovery of industrial scrap and jewelry silver, which quietly offsets part of the structural deficit without attracting much attention from retail investors. This recycling response mechanism is one of the most underestimated stabilizers in the silver market. Another overlooked factor is that the majority of silver demand growth today is industrial rather than investment-driven. Industrial demand is strong, but it is also cyclical. When manufacturing slows, industrial consumption slows with it. That creates natural downward pressure on prices even during periods that appear structurally bullish on paper. Solar manufacturing, electronics production, and electric vehicle expansion are often cited as long-term drivers of silver demand. While that is correct, those sectors are also highly sensitive to credit conditions, interest rates, and global trade flows. If financing conditions tighten or export demand weakens, industrial silver consumption can adjust faster than investors expect. Markets price forward expectations, not just current demand conditions. This is why the assumption that 6 consecutive deficit years must inevitably lead to a breakout in silver prices ignores an important historical pattern. Structural deficits only produce sustained rallies when they coincide with accelerating investment demand. Without that second component, price movement tends to remain contained inside broad consolidation ranges rather than transitioning into explosive bull phases. There is another layer to consider here as well. Exchange inventory drawdowns are frequently interpreted as evidence that physical silver availability is collapsing, but inventory declines do not necessarily indicate shortage conditions. They can also reflect inventory relocation between exchanges, private vaulting systems, and industrial supply chains. In other words, metal leaving one reporting system does not mean metal disappearing from the market entirely. The global silver ecosystem includes commercial storage networks, sovereign reserves, refinery pipelines, and industrial stockpiles that are not always visible through public exchange reporting structures. As a result, interpreting exchange inventory changes as direct indicators of scarcity can sometimes exaggerate the real level of supply pressure. This matters because the bullish thesis increasingly depends on the assumption that declining inventories are approaching a critical threshold. At the moment, there is still no clear evidence that such a threshold has been reached. Even more importantly, silver pricing continues to be heavily influenced by leveraged futures positioning rather than purely physical availability. That means sentiment, macro liquidity conditions, and interest rate expectations still play a larger role in near-term price direction than structural deficits alone. This explains why silver has struggled to maintain momentum above key resistance levels despite what appears to be one of the strongest fundamental backdrops in years. Markets are not rejecting the deficit story, they are simply not responding to it yet. And until investment capital begins rotating aggressively into silver alongside industrial demand strength, the supply deficit narrative by itself is unlikely to be sufficient to trigger the type of breakout many investors are expecting in the short term. Understanding this distinction is essential before assuming that structural tightness automatically translates into structural upside. While the fundamental argument for silver continues to gain attention, the technical structure of the market is still sending a very different message. And in commodity markets, when fundamentals and technicals diverge, price direction is usually determined by liquidity positioning rather than long-term narratives. Right now, silver remains trapped below the 100-day moving average after multiple rejection attempts. That is not a minor technical detail. It is a signal that institutional positioning has not yet aligned with the bullish thesis many investors are building around the metal. Moving averages at this scale are not retail indicators. They are reference frameworks used by algorithmic execution models, commodity trading advisors, and macro funds that control the majority of futures liquidity. When price repeatedly fails at the same level, it suggests that supply is still entering the market at predictable zones of strength. That behavior does not occur during early breakout phases. It occurs during transition phases where momentum is still being absorbed by sellers. The descending wedge structure currently visible in silver is often interpreted as a bullish reversal formation. But that interpretation only becomes valid after confirmation through volume expansion and sustained closes above resistance. Until that confirmation occurs, a descending wedge remains a neutral compression pattern rather than a directional signal. Markets frequently break downward from wedge structures when macro liquidity conditions remain restrictive. This is especially important in the current environment because silver is not trading in isolation. It is trading inside a global framework shaped by interest rate expectations, currency strength, and capital allocation decisions across the broader commodities complex. Relative strength indicators are also reinforcing this cautious interpretation. The RSI remains below the neutral 50 level. That means downside momentum is weakening, but it has not yet reversed. Momentum transitions always move through phases, and the market has not yet entered the phase where buyers are clearly in control. Similarly, momentum oscillators have begun stabilizing but remain positioned inside negative territory. That combination typically signals consolidation rather than expansion. In practical terms, the market is not confirming a bullish breakout environment yet. Another key issue is horizontal resistance near the $79 range. Price has repeatedly struggled to reclaim this zone with conviction. When resistance levels are tested multiple times without success, they become stronger rather than weaker because traders begin using them as predictable execution points. This creates self-reinforcing selling pressure. Institutional traders do not need to believe a bearish narrative to sell into resistance. They only need confirmation that other market participants are doing the same. That is how technical supply zones form and persist over time. If silver continues failing to reclaim this level, the probability of a continuation move toward the $54 to $60 support region increases materially. That area represents the intersection between long-term trend structure and historical support floors that previously defined major accumulation zones. Testing those levels would not invalidate the long-term silver thesis. It would simply mean the market needs more time to build a base before transitioning into the next expansion phase. There is also an important behavioral dynamic at work here. When investors become convinced that fundamentals are overwhelmingly bullish, while technical confirmation is still missing, positioning tends to become crowded on one side of the market. Crowded positioning increases volatility risk because even small downside moves can trigger leveraged liquidation cascades. That is exactly how corrective legs inside long-term bull markets typically develop. Price does not fall because the fundamentals changed. Price falls because positioning became premature. This is why confirmation levels matter so much. A sustained move above the $92 region would invalidate the current continuation structure and shift the technical balance decisively toward the upside. Until that happens, the market remains inside a controlled compression phase where both bullish and bearish outcomes remain possible. Understanding that distinction is essential because markets rarely reward conviction alone. They reward timing. After examining the import data from China, the supply deficit narrative, and the technical structure currently shaping price behavior, one conclusion becomes increasingly clear. The long-term case for silver remains structurally intact. However, structural strength does not automatically translate into immediate price expansion, and this is where many investors make their biggest mistake. They confuse direction with timing. The strongest argument supporting higher silver prices over the coming years is not speculative positioning, short-term import flows, or even exchange inventory movements. It is the steady transformation of global industrial demand combined with constrained mine production growth. These forces are real, measurable, and persistent across multiple economic cycles. But markets do not move simply because long-term demand trends exist. They move when liquidity conditions allow those trends to be priced in. Silver sits at the intersection of two different market identities. It is both a precious metal influenced by monetary expectations and a strategic industrial metal tied to manufacturing activity. That dual identity creates a situation where silver often underperforms during periods of macro uncertainty, even when its long-term fundamentals remain strong. This explains why silver frequently lags gold during early stages of precious metal cycles. Gold responds first to monetary conditions. Silver responds later when industrial confidence strengthens and capital begins rotating into higher beta assets. Until that transition begins, silver can remain range-bound even while the broader precious metals environment improves. Another important factor that investors should not ignore is the role of leverage inside the silver futures market. Unlike physical silver buyers, futures participants operate within margin-based positioning structures that amplify both upside and downside volatility. When positioning becomes crowded before confirmation levels are reclaimed, even fundamentally correct investors can be forced out of positions by short-term technical pressure. This is not a failure of analysis. It is a failure of timing alignment between thesis and execution. The current technical structure still suggests that the market is searching for equilibrium between physical tightening signals and financial liquidity conditions. Until price can establish sustained acceptance above the 100-day moving average and reclaim higher resistance zones with conviction, the probability of continued consolidation remains elevated. And consolidation is not weakness. Consolidation is preparation. It allows speculative excess to reset. It allows positioning to rebalance. It allows markets to transition from narrative-driven expectations toward confirmation-driven participation. Without that process, rallies tend to fail because they are not supported by durable capital flows. There is also a geopolitical dimension to consider when evaluating China's silver import activity. Strategic resource management does not always translate into immediate global price impact. Governments accumulate critical materials to stabilize domestic industries and reduce external dependency risks. That behavior strengthens internal resilience, but it does not necessarily produce short-term price acceleration across international trading venues. In many cases, the price response appears only after supply adjustments begin affecting multiple regions simultaneously rather than a single national market. This is why interpreting China's behavior as an immediate catalyst for global repricing may be premature. A more balanced interpretation is that China's actions are reinforcing a long-term structural trend rather than triggering a near-term breakout event. And that distinction matters for investors attempting to position correctly inside the current cycle. The silver market today is not sending a single unified signal. The physical market suggests tightening conditions. The futures market suggests unresolved resistance. The macro environment suggests conditional support depending on interest rates, currency strength, and industrial momentum. When markets deliver mixed signals like this, the correct response is not certainty. It is discipline. Because the next decisive move in silver will not be determined by one data point, one policy decision, or one technical level alone. It will be determined by the moment when physical fundamentals, macro liquidity, and technical confirmation finally begin moving in the same direction at the same time. And until that alignment appears, patience remains not a passive strategy, but a strategic one.